Okay, good afternoon. So today I want us to look at the borrowing cost. So the borrowing cost is normally guided by IAS number 32, and our expected learning outcome for this lecture will be number one. We'll be able to define the borrowing cost and explain the component. You need to be able to identify qualifying asset for capitalization of borrowing cost, apply the principle for capitalization and cessation of capitalization, record the present borrowing cost appropriately in financial statement, and to distinguish between borrowing cost eligible for capitalization and those to be expensed. Now, what are these borrowing costs? So the borrowing costs are interest and other costs incurred by an entity in connection with the borrowing of funds. So when you go to any financial institution to borrow some funds, there are some expenses or costs that are associated with the borrowing. For example, you may find that there are costs related to the legal fees, charge fees, etc., etc. So these are what we are referring to as the borrowing cost. According to IAS number 23, borrowing cost may include one, interest expense calculated using effective interest method, that is as per FRS 9, which guides FRS 9 is the one which guides the impairment of receivable loans and etc. Finance charge in respect to finance lease as per FRS 16. So previously it was IAS 17, which was replaced by FRS 16. Then we have the exchange differences arising from foreign currency borrowing. So in the event that you take a loan which is foreign denominated, for example, a loan in USD, so the foreign exchange that is associated between the local currency and the foreign currency, it's also going to be part of the borrowing cost. So now we have the concept of capitalization of the borrowing cost. So now the capitalization, this is where you have to, instead of expensing the borrowing cost, that is debiting the profit and loss account, you accumulate this borrowing cost to be part of the asset. That is what we call to capitalize. You make it a capital item. So what are the qualifying assets? A qualifying asset is an asset that necessarily take a substantial period of time to get ready for its intended use or sale. So for example, building a mall or building a factory or building a hotel or building a hospital. So this asset, they normally take a very long time for them to be completed, maybe 2 or 3 years. So we have examples here like manufacturing plants, power generation facilities, real estate development, inventory requiring substantial time to produce, large infrastructure projects like roads and bridge. Then we have the borrowing costs that are eligible for capitalization. So these costs include one, the interest expenses on borrowing specifically taken out for the purpose of acquiring, construction, or producing the asset. Finance charge relating to finance lease that are directly attributable to the construction or production of the qualifying asset. Other borrowing costs, such as amortization of discount or premium related to borrowing and certain exchange difference on foreign currency borrowing to the extent they are regarded as an adjustment to the interest cost. So these are the costs which are basically eligible for capitalization. That is, these expenses, you don't expense them to the P&L directly, but you accumulate them and add them to the cost to be part of the asset cost. So for example, if the asset cost, let's say, was 5 million, then we have all these other costs, expense cost, finance charge, and other borrowing cost. You should add them to this 5 million to form the overall total cost of the asset. And then when it comes to the depreciation, you'll be depreciating that asset as a whole. So when do this capitalization begin? So the capitalization begin, number one, when expenditure for the asset is being incurred. 2, borrowing costs are being incurred. 3, activities to prepare the asset for its intended use or sale are in progress. And 4, the capitalization ceases when substantially all the activities necessary to prepare the asset are completed. So when you take out loan from a bank or any financial facility, then you need to capitalize this cost. You should start when, for example, the first withdrawal that is intended for that particular asset. Yeah, the borrowing costs are being incurred. So there are those preliminary expenses that you incur when you are doing the borrowing, when the bank are doing the due diligence, the legal fees, the search if it's allowed, etc. And all the activities necessary to prepare the asset for its intended use or sale are in progress. So for example, if there are some minor repairs, all those costs. But then the capitalization should stop. The capitalization for this borrowing cost should actually stop when all these necessary activities to prepare the asset are completed. So when the asset is complete, then you don't have to continue to capitalize the expenses. So there is a concept of suspension and cessation. So suspension, this is capitalization of borrowing cost, or capitalization of the borrowing cost should be suspended during the extended period where active development of the asset is interrupted. So if, for example, the asset has been interrupted for, let's say, a period of 2 years, then you should stop capitalization because that's a long period of time. Actually, 1 year is a long period that you should stop capitalization of the borrowing cost. Then we have the cessation. Capitalization ceases when substantially all the activities necessary to prepare the asset for its intended use or sale are complete. So again, you need to get the clear difference between suspension and cessation. So suspension, it is where you suspend for a period of time. So after maybe the construction or the activities related to completion of the asset continues, then you lift the suspension. Then cessation, this is ceasing, you stop completely. So you stop capitalizing this cost. But this can only happen when a significant activities for setting up the asset for its intended use or sale are complete. Then we have the borrowing costs, which are not eligible for capitalization. So these costs include borrowing costs on borrowing used to finance the acquisition of asset that is not a qualifying asset. So we have looked at what is a qualifying asset, and we have said these are assets which take substantially a long period of time to complete. Then we have the borrowing cost incurred after the asset is ready for its intended use or sale. So if there is any expense that is incurred, that's the borrowing cost that is incurred after the asset is ready for its intended use or sale, then that is not capitalized. And then we have the general borrowing, not directly attributable to a specific qualifying asset, although a portion of the general borrowing cost may be allocated to a qualifying asset under a certain condition. So if you have the general borrowing cost, but this general borrowing cost, you can't be able to directly attribute them to a specific qualifying asset, then these general costs are not capitalized. But you are going to see how we can apportion the general borrowing costs for capitalization. Then we have the specific versus general borrowing. So the specific borrowing, these are loans taken specifically for a qualifying asset. So if, for example, we are doing a manufacturing plant, you take a loan and everything you direct it to the construction of the manufacturing plant. Then there's a concept whereby you may take this loan for the construction of the manufacturing plant, but let's say, for example, you took 10 million, but in the middle, you find that you take 2 million and invest it in a certain fund for you to gain some investment income. If that happens, that investment income, you are going to deduct it for capitalization. Then we have the general borrowing. These are funds obtained and used partly for qualifying assets. So general borrowing, you can take, let's say, 10 million, part of it use it for qualifying asset, and part of it used for other use. So in this case, apply capitalization rate, that is weighted average of borrowing cost applicable to general borrowing to the expenditure on the asset. So we are going to see practically how you can apply the weighted average of borrowing cost so that you can come up with a portion that is going to be capitalized. Accounting for the borrowing cost. So the capitalization journal. So when the borrowing costs are directly attributable and capitalized, so you normally debit the asset, that's qualifying asset, and credit the borrowing cost or the loan payable account. But when the borrowing cost is not related to the qualifying asset, so you need to debit the finance cost, that is the profit and loss account, and credit the loan payable or cash. An example, Kibo Limited is in the process of constructing a new office building that will take 2 years to complete. The company has taken out a loan specifically to finance the construction, and the following details relate to its financing activities. On 1st January 2024, Kibo Limited borrowed 10 million at an annual interest rate of 8%, specifically for the construction of the project. The loan is to be repaid after 5 years. General borrowing during the year include a loan of 15 million taken out on 1st April at an interest rate of 6%, a loan of 8% taken out on 1st July 2024 at an interest rate of 7%. Kibo Limited has invested 3 million of surplus fund from the specific borrowing in a short-term investment that yields 5% interest annually. Construction of the office building commenced on 1st March 2024. And expenditure on the project were incurred as follows: 2 million on 1st March 2024, 4 million on 1st June 2024, 3 million on 1st September 2024, 1 million on 1st December 2024. The construction project was temporarily halted from 1st November 2024 to 31st December due to legal issue with the property zoning permits required. Number one, define borrowing cost and explain the condition under which they are capitalized as part of the cost of the qualifying asset. B, compute the amount of borrowing cost that can be capitalized for the year ended under 1st December 2024, considering both specific and general borrowing, as well as the temporary suspension of the construction work. C, explain how the treatment of borrowing costs would change if Kibo Limited had halted construction voluntarily for non-essential reasons, such as internal financial restructuring. Now, the definition. So we say that borrowing costs are interest and other costs that an entity incur in connection with the borrowing of funds. According to IAS 23, borrowing costs that are directly attributable to the acquisition, construction, and production of a qualifying asset take a substantial period of time to get ready for its intended use or sale and must be capitalized as part of the cost of that asset. Then we have the conditions for capitalization. The conditions include qualifying asset. The asset must take a substantial period of time to be ready for use or sale. Direct attribution. The borrowing must be directly attributable to the asset construction, e.g., the borrowing was specifically taken for the purpose of financing that asset. Then we have the commencement of capitalization. Capitalization of the borrowing cost start when, one, expenditure for the asset are being incurred, borrowing costs are being incurred, activity necessary to prepare the asset for its intended use are in progress. Then you have the suspension of capitalization. So capitalization should be suspended during period in which active development of the asset is interrupted. Like there you have the legal issues. Cessation, once the asset is substantially ready for use or sale, capitalization must cease. Then let us do the computation of the borrowing cost to be capitalized. So first, we need to work on the specific borrowing cost. So a loan of 10 million was taken, and we are told that this 10 million was specifically for on 1st January 2024 borrowed 10 million at an annual interest rate of 80%, specifically for the construction project. The loan is to be repaid after 5 years. So this 10 million was specifically taken for this project. But we are also told Kibio Limited has invested 3 million of surplus fund from the specific borrowing in a short-term investment that yield 5% interest annually. So how should we go about this? First, it is to calculate the total interest. So the interest incurred will be 10 million times 8%, which is 80 million, because that's annually. Then we have the interest income from the amount that was invested. So 3 million times 5%, which is 150. So the net interest from the specific borrowing will be 80 million minus 150, which gives 650. So 650 is the one that is going to be capitalized. Remember, we said that if the 10 million, you take some money and do some investment, the interest earned from that particular investment is not part of the amount that you are going to capitalize. Then we have the general borrowing. So we had a loan of 15 million at 6% from 1st April to that 1st December. So get that, that's 15 million times 6% times 9 over 12, which give you 675. And 9 over 12 is because we are working from 1st April, 31st December. Then 80 million at 7% from 1st July to 31st December. Again, that is 80 million times 7% times 6 over 12, which is 280. Total interest for general borrowing will be 675 plus 280, which is 995. Then we need to get the weighted average interest rate for the general borrowing. So the total borrowing is 15 million plus 80 million, which give you 23 million. Weighted average, it is the total interest from the two loans or over the total amount of the loan, which give you an interest rate of 4.15%. Then the second thing is to get the expenditure. So this is how the amount has been used. So 2 million, it was for 10 months. Average expenditure is going to be 1.6. So we get 1.6 by taking 2 million, you multiply by 10 months, you divide by 12, you get that. 4 million multiplied by 7 over 12, you get that. 3 million multiplied by 4 over 12, you get that. 1 million, you multiply 1 over 12, you get that. So the total weighted average expenditure will be the sum of you add the 3 to get 5 million. So then, capitalization of the general borrowing cost, you need to apply the rate of that we have calculated in the previous slide of 4.15. So you get the total borrowing cost to be capitalized will be 5 million times 4.1% to get 210,958. That is the total borrowing cost to be. So the total that's the total cost to be capitalized from the general borrowing. Then we need to get the total cost to be capitalized. And the total cost to be capitalized, you need to add the specific one, which is 650 plus 210 from the general to get 860,958. Then the last question, impact of voluntary suspension of the construction. So if Kibio Limited had voluntarily halted construction for non-essential reasons, the capitalization of the borrowing cost should be suspended during the period of inactivity, according to IAS 23. Borrowing costs should not be capitalized during the period in which active development is not taking place unless delay is beyond the control of the entity, such as legal or regulatory issues. In such scenario, the interest incurred during suspension period would be expensed in the income statement rather than being capitalized. So that is how we work on that. And to test our understanding on this, I have given out this class activity. So kindly try out this class activity and possibly we can discuss at a later time. Thank you and have a good day.